Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's get across what happened overnight. Wall Street in a bit of a holding pattern at the moment. That was ahead of Nvidia's results. I'll get to that in just a moment. But the S&P essentially flat, the Nasdaq marginally lower, and the Dow off by about 1/5% there. There was a drag on chip stocks ahead of that key result from Nvidia after the bell. So, second quarter FY27 results, a huge beat across every major line, but the stock did dip most immediately after that, after the release, because expectations were even higher than the already lofty consensus. Revenue in the current period was $108 billion US, gross margins around 74%. Elsewhere, Salesforce jumped in extended trade after the software company gave an outlook for a strong revenue expansion and deepened its partnership with Anthropic, reassuring investors that it can compete successfully in the AI era. HP shares, they fell after investors looked past a widely expected boost in the company's profit forecast and worried about future demand for computers and printers. Elsewhere, we saw United Health, Travelers, Cisco, they were bright spots, whereas Alphabet and Merck were drags on the broader index there. On the macro front, in the US, July's core PCE, the Fed's preferred measure of inflation, came in at 0.2% month on month, 3.3% year on year, which was pretty much in line with expectations. Some of the broader numbers ran a touch hotter, but core held steady, which does give the Fed breathing room to sit on its hands. For now, at least, we will be hearing from Fed Chair Kevin Warsh Friday at the Jackson Hole Symposium. On the geopolitical front, Iran's military said it reached a revenue sharing agreement with Oman on the Strait of Hormuz as the standover over the control of the crucial waterway continues. And a statement from Islamic Revolutionary Guard Corps saying agreements have been reached regarding each country's share of the Strait's waters, as well as Iran and Oman's share of its revenues. Well, the US 2-year Treasury yield rose to 4.23%, the 10-year at 4.67. The Australian 3-year government bond yield futures rose to 4.65, the 10-year at 5.09. Markets now pricing in a 35% chance the cash rate will be hiked by 25 basis points at the next meeting at the end of September. 90% chance by November. That comes after that hotter than expected CPI read we got yesterday. US dollar index up around 1/5%. The Aussie currently trading at 71.8 US cents. Oil prices have slid as the US tightened sanctions on Iran. Brent crude at around $87 a barrel. Gold slightly higher at around $4,670 an ounce. And Bitcoin, that's currently trading just over 79,000 US dollars. Let's now get a closer look at what's going on in Asia. We're joined by Market Commentator Yeung. Catherine, welcome.
Hello, Andrew.
Good to have you. We haven't spoken to you in such a long time, so good to have you in the studio with us. So, well, let's first take a look at what you're seeing in Japan, because, I mean, that's been a focus, particularly given that weakness of the yen. We saw intervention. What are you seeing at the moment, and what's to come, do you think?
I think it's more than just the weak yen narrative. So if you're looking at the companies from a corporate governance perspective, you're seeing a lot of capital raisings, you're seeing share buybacks. So share buybacks about 22 trillion yen, which equates to about 190 billion Aussie dollars. You're seeing interesting dividend payouts. And very interestingly, you're seeing shareholder activism rates go up. So up over 50% over the first half of this year. So that puts Japan now as the second, after the US, largest global activist campaigner. So all those factors make Japan very interesting from an equities perspective. And interestingly, the pension fund, so GPIF, which is the world's largest pension fund in the world, they're looking to potentially buy back in terms of domestic assets, especially bonds, given where Japanese rates are versus US Treasuries. So there's a really interesting flaw there, Andrew.
How does that picture pan out when you say perhaps moving back into Japanese bonds from US Treasuries, given what we're seeing obviously in the US Treasury market and that intervention by Scott Bessent?
It will be interesting because the likes of GPIF have about 200 billion worth of US Treasury holdings. But if you can get the rates a similar level in Japan, then that just attracts more domestic flows into the Japanese market.
And you talk about activism being up. Why is that then?
just a change in the structural reforms that we're seeing in Japan. So historically, they'd sit on hoards of cash, a bit like some of the Korean companies, and now they're actually, distributing that cash back to shareholders. So this has been going on since the 5 Arrows announcement many, many years ago, but it's good to see that it's actually being implemented, all these regulatory changes.
You mentioned Korea. I must ask you about that. This year has just been amazing, hasn't it? Those market moves, and much of that driven simply by two stocks.
Yeah. And those two stocks make up the bulk of the Kospi. What's interesting, though, is on the ground in domestic Korea, you're seeing a lot of local investors actually taking out leverage to build up their equities portfolio. So it feels a little bit frothy, a little bit like Taiwan. I mean, I know TSMC is massive, but just those numbers are just, when you look at valuations, just a little bit frothy.
Yeah, well, I think just recently we had that event where the massive margin calls across the board. Scary stuff. Let's move to China then, what we're seeing there, and I guess with a reference to Australia too, given demand particularly for our resources, it's still looking weak as far as you're concerned?
I still think China is very, very interesting from a broad asset allocation perspective. And if we look at China, we've got the weak consumer still, although people are spending, but on low cost items, not big end items. You're seeing a slower recovery, I should say, in the property market. And then China's big in the tech space. So I know we all talk about Taiwan and Korea and Japan, but the Chinese tech companies and the AI companies are doing amazing things. So when you look at the dividend story even in China, so the banks are reporting tomorrow, the big banks, they're paying out like up to a 5.5% dividend yield. So that stability in some of those sectors remains intact. And again, that tech story is sort of moving along. It's not getting much airtime because of China's neighbours.
Well, and of course we've seen the US try to isolate China as far as access to resources in particular and chips in terms of building out their tech sector. Do you feel as though China has moved on from that? They're going their own way in so many different industries at the moment, and particularly I guess what we're seeing on the trade front with Donald Trump once again opening up a new front in terms of his tariffs. And also China has been hit by those renewed sanctions on Iran, given they do deal with Iran. It's
the whole beggar thy neighbour idea between China and also the US. So the geopolitical risk is still definitely there. But what we do need to see come through in terms of the China story is that recovery in the domestic consumer themselves. Because that export side, again, they've got the exports, they're manufacturing, those numbers are good. It's a domestic demand story we really need to keep an eye on.
Catherine, you're based in Hong Kong. What's the vibe there at the moment?
It's massively picked up. It's good, and a barometer such as wait lists for international schools or getting reservations at restaurants, that's all become quite tight in terms of there's long lists. The Hong Kong government has proposed, it would have been signed off by Beijing, they call it the Big Bang fund tax cut. And essentially it means hedge funds, etc., with their performance fees, their carry interest, the income is taxed at 0%. So really trying to attract hedge funds, establishing themselves in the city, taking away competition from Singapore, United Arab Emirates, and also the UK itself.
So are we looking at institutions, large companies actually moving back to Hong Kong?
And those sort of hedge fund setups. And again, if we look at the Hang Seng Index, it's still attractively valued with some of those really interesting names that I spoke about coming from mainland China as well in there.
Of course, underlying is that issue of democratic rights and so on. Is that still bubbling beneath the surface there? I mean, as a resident, do you actually confront that day to day or not?
No, I don't think so. So, again, when you look at the people moving to Hong Kong, the property prices, rentals, they get snapped up in an instant. The place just feels really vibey again and exciting. And I think Hong Kong's never going to lose its position as a major financial centre hub.
Well, obviously, being a rival with Singapore, do you feel as though perhaps to the detriment of Singapore that people may now move back to Hong Kong?
I'm biased towards Hong Kong.
Yeah.
Both are great cities, but you can definitely see that interest picking up in Hong Kong because of these tax changes.
Catherine, more broadly, what of emerging markets? Obviously, we've touched on some, but perhaps some of those other economies, such as closer to home here, Indonesia, which has been struggling, for instance. Vietnam is emerging. Where are you seeing the opportunities at the moment?
Lots of opportunities, but I guess it's that sort of the reliance on company management and how you rate company management, plus the overall economic recovery of these companies. That long-term structural story about domestic demand and the growth of wealth management, that's all still intact. But again, Asia is still very much tied to if we see global inflation come out a lot worse than expected. So there are those geopolitical and global macro risks that we need to factor in.
Catherine, terrific to catch up. Thanks so much for joining us.
Thanks, Andrew.
All right, now let's turn our attention to where we're likely to open this morning on the local market. As you can see, down marginally, just some 4 points. Bit of a mixed picture there, perhaps reflecting what we saw on Wall Street overnight. But clearly the focus today will once again be reporting season. A couple of very large companies reporting, including Woodside, Wesfarmers, MinRes, among many that are to report today. We'll try and get across as many as we can. Join us in just a moment for the open.